Hello and welcome. This is Collier from Make Your Money Work for You. In this short training, I will be discussing a very important step that you should follow before you begin investing: getting out of debt. The Before You Invest series are important lessons. Please do not skip these lessons on your way to becoming an investor. Again, my name is Collier. I'm an investor and personal finance trainer. My goal in this course is to teach you why getting out of debt is an excellent first step towards becoming a successful investor. Get out of debt. There's a saying that I like to quote about investment money. Your money is going to work for someone. The question is, who? When you are in debt, the money you earn is profit for your creditors. As a borrower, you are a slave to the lender. You work 40 hours a week, get a paycheck, and within 24 hours, you pay your creditors with very little left over for yourself. Does this sound familiar? The money that you earn is your potential investment dollars that could be working for you. Instead, they're working for your creditors. Meanwhile, your creditors get rich while you barely make ends meet. This is no way to live. So to free yourself, learn how to control your spending. Don't buy stuff that you don't need. Stop financing liabilities. If you can't pay for it in cash, you can't afford it. That's why it's called a liability. You're lying on your ability to afford it. Learn how to live below your means, especially in your early years of investing. You need that seed money to plant an orchard. There will be plenty of time later to eat some of your harvest. Focus on debt elimination. I recommend the Snowball Debt Elimination Plan. It's easy and simple to implement. Pay off your debts as soon as possible. Now, the question of whether you should pay off debts first or invest is not a simple, straightforward answer. You must approach the answer from a mathematical deduction. Eliminating debt, however, in most cases, is going to win over investing first. There are a couple of factors that you may want to consider. The first factor is interest rates. Depending on the interest rate that you're paying on debt will make a huge determination on whether you should invest first or pay off debt. For example, a home mortgage is usually at a low interest rate in the single digits. It may not make mathematical sense to pay off the mortgage first. However, credit card debt almost always makes more sense to pay off first. Time value. One of the greatest assets you have with investing is time. The more time you have, the more time you have for your money to compound. Time is a precious commodity. And then finally, personal preference. At the end of the day, whether you pay off debt first or start investing immediately comes down to your personal preference. If it makes you feel better to pay off debt first, then do it. If you feel better by investing a little while you pay down debt, well, do that. You see, it's important that you are motivated on your process for creating wealth. Without the personal motivation, you will not make it either way. Now, let's take a look at 3 scenarios. The first scenario is you put $5,000 in a bank savings account that pays you 0.03% interest. Most people would say that a bank is a safe place to invest. The second scenario is you put $5,000 in the stock market and you average a 10% return on your stocks. And finally, the third scenario is you pay off a $5,000 credit card that has a 21% APR. Now let's see which is the better choice. At the end of year 1, the $5,000 in the bank earns you $1.50 in profit before taxes. Yes, you have to pay taxes on the $1.50. At the end of year 1 in the stock market, your $5,000 has earned you $500 in profit before taxes. Not bad. Let's now look at the credit card. By paying off the credit card, you will have avoided paying $1,050 in interest. So in this example, paying off the credit card earns you 2 times as much as investing. plus the entire $1,050 in savings is yours to keep without worrying about before taxes. Saving $1,050 is like making $1,050. The question here is, would you rather earn $500 or avoid paying $1,050? In summary, paying off debt mathematically almost always works better. In addition to that, as an investor, the last thing you want over your head as you're investing your money is debt. If you know you have some debt, you may not trade as well knowing that this debt is still needing to be serviced. I also like the option of taking the guarantee. What do I mean by that? There are many times in finances that you will not have a guarantee. By paying off a 21% credit card, that's like getting a 21% rate of return guaranteed. And finally, by paying off your debt first, you can use that time to learn investing. There are several paper trading platforms that you can practice on, sharpening your trading skills while becoming debt-free. I'd like to thank you for watching this short presentation. I hope it's giving you some things to consider before you start investing in the stock market.